Hello, this is Bob Steele. In this lecture, we will be taking a look at a problem that will be very similar to the homework and or assignment. The numbers will change. The format will remain much the same. The assignment will look like this, and we will be putting it into an Excel sheet that will look like this. I do suggest using the Excel sheet, even if you are then going to put it into Connect for multiple reasons. Excel will really help with the calculations. Excel will help if you need to work the problem again, and Excel is, of course, good to know. So let's take a look at the data here. We've got the beginning balance sheet that we're going to use in order to create our master budget. Then we have some more information down here. To prepare the master budget for April, May, and June 2015, management gathers the following information. Sales for March totaled 20,500 units. Forecast sales units are as follows: April 20,005, May 19,500, June 20,000, July 20,005. Sales of 240,000 units are forecast for the entire year. The product selling for $23.85 per unit, and total product costs are $19.85. B, the company policy calls for a given month's ending raw materials inventory to equal 50% of the month's materials requirement. The March 31st raw materials inventory was 4,925 units, which complies with the policy. The expected June 30th ending raw material inventory is 4,000 units. Raw material cost $20 per unit. Each finished good unit requires 0.5 units of raw material. Number C, letter C, company policy calls for the given month's ending finished good inventory to equal 80% of the next month's expected units sales. The March 31st finished goods inventory are 16.4 units, which complies with the policy. Each finished good requires 0.5 units of direct labor at a rate of $15 per hour. E, overhead is allocated based on direct labor hours. The predetermined variable overhead rate is $2.70 per direct labor hour. Depreciation of $20,000 per month is treated as fixed factory overhead. Sales, F, sales representing commissions are 8% of sales and are paid in the month of the sale. The sales manager monthly salary is $3,000. G, monthly general administrative expenses are $12,000. Administrative salaries and 9% monthly interest on the loan, long-term note payable. The company expects 30% of sales to be for cash and the remaining 70% on credit. Receivables are collected in full in the month following the sale. And then I, all raw materials purchased are on credit. No payables arise from any other transaction. 1 month's raw materials are fully paid in the next month. And J, the minimum ending cash balance for all months is $14,000. If necessary, the company borrows enough cash using a short-term note to reach the minimum. Short-term notes require an interest payment of 1% at each month end. If the ending cash balance exceeds the minimum, the excess will be applied to repaying the short-term notes. K, the dividends of 10,000 are to be declared, and I, no cash payments for income taxes are to be made during the second calendar quarter. Income tax will be assessed at 35% in the quarter. And then finally, M, equipment purchased of 130,000 are budgeted for the last day of June. So keep all that in mind as we go forward. We will start off with the sales budget, number 1. So we have the sales budget over here. I'm going to go to the top of the worksheet, and as of April, we have the 20,005 units, which we are pulling from here, and then the 19,500 and the 20,000. We'll use our trusty sum function to sum that column up, and we know that the sales is coming from our data over here at $23.85 per unit. So we have $23.85 per unit. That's going to be the same all the way down. Therefore, we're going to take the sales in units times the price per unit and get the sales. We can then copy and paste or autofill this down like so. We can use our sum function here to sum this up like this, and we have this data. Next, we'll take a look at the production budget for April, May, and June, and note we have the next month's budgeted sales in units. So we're in April, and of course we're looking at the next month's budgeted sales in units. So we're going to say that this equals, and we're in April, and we're going to take May's because we're talking about next month. And if we're going to pull that over and do the same thing, we're in May, and we're talking about June then, and then we're going to pull that over. And if we're in June, then we're going to pull this number from the data at 20,005. Then if we look at number C, or letter C, we have the company policy calls for a given month's ending finished goods inventory of 80% of the next month's expected units sales. So we're going to have 80% ratio here. And then we can multiply that out. So we're going to say this equals the 19.5 times the 80%. We can copy that across. That should be the same number, or the same relative formula all the way across. And then we're going to have the budgeted unit sales for the month. So for the sales for this month, being now we're in April, we're going to take the April, and we're going to take the May, and we're going to take the June. And that will give us the 15.6 plus the 25, the 36.1 required units to be available for production. So if we copy that across, we have that for the quarter. Then we have to add to that the beginning inventory. So the beginning inventory we know for May and June will equal the ending inventory for the prior months. So for May, I'm going to make it a negative instead of by saying negative of the ending inventory here. Same here. We're going to say the beginning inventory for June is the negative of the ending inventory for May. And then to calculate the April, we can look at the financial statement and say that it's going to be the 325,540 divided by the cost of 19.85, and that will give us the beginning number here. I'm going to do that again by saying it's negative of the 325,540 divided by the cost, which is here of 19.85. So then we can say this plus this, because that's a negative number, will bring us to the 19.7. Then we can copy that across. So we just add this minus this, in a calculator would be this minus this. Then we're going to sum this way, and that will give us our total for the quarter. Next, we'll calculate the raw materials budget. So we're going to start off with the production budget. So that's the first thing we need to do, is the production budget, in order to complete the materials we need now. So this is how many units we want to produce. Now how much material do we need in order to make the 19.7 units? So we're going to say we're going to start off with the 19.7 units that we need to produce. And we'll copy that across all the way. That's what we're going to produce for each month, the number of units. Then we have the material required per unit. And the material required, we only need half a unit. So each finished unit requires 0.5 units of raw material. So whatever this raw material is, we only need half of it. We need the 0.5 units of it for each unit we're going to create. So if we're making 19.7, we're going to take the 19.7 and take it in half. And we only need half of it of the particular raw material to make the number of units that we need. So we're going to do the same thing here. We're going to say that 19.9 times 0.5, we took half of it. And then we're going to take the 0.5, and we're going to take the 20,004, and we're going to take half of that and come up to the 10.2. Now we're also going to want a cushion in the raw materials, just as we would in our inventory as a whole. So we want to have some inventory budgeted to be there, and we're saying that's going to be 50% of the next month's materials requirement. So for the month of April, we can say next month we're budgeting here times 0.5. That's how much we want to have left over in our ending inventory. We're going to say this next month times 0.5. And then for the last month, they're going to have to give us it in the problem. The expected June 30th ending materials inventory is 4,000. So there we have those items. So then total materials required in units. This is how much we're going to need to produce. This is how much we want as a cushion. Therefore, the total units are going to be summing those up. We can copy that across. This is how many units we'll need in order to cover those two items. Then we're going to subtract out what is already in there. So that once again for May and June, we can pick that up because it's going to be, we're going to say less the negative of the last period's ending inventory, which we estimated to be this. So we're going to say negative of last period's ending inventory. And then for April, they're going to have to give us that in the problem. So in the problem over here, we have March 31st raw materials of 4925. So we're going to say if they give us for this 4925, and we have that. Therefore, materials to be purchased are going to be this. I'm going to say plus that because that's a negative number. It's going to subtract in the calculator, of course, to give us the 99. We can copy that across. We can sum that this way. So this is the materials we need to purchase in units. And then they gave us the dollar amount per unit. How much does it cost per unit? In this case, it costs $20. So there's the number of dollars it's going to cost per unit. Therefore, we're going to say this equals the 9,009 we got to purchase in April times 20 in this case. And that gives us the 198. If we copy that across, we have this. And then again, if we sum them this way, we get the 581.5. Or if we multiply the total materials for the quarter times 20, we'll get the 581.5. So that's what we're budgeting for raw material. Now let's talk about the budget for labor. And once again, we're going to start off in the same area. We're going to say, well, how much stuff do we need to produce? And then think about how much labor it takes to produce it. And we're going to get that from the production budget again. So we're producing 19.7 units in April. And if we copy that across, that's how much we're producing in May and June. Then how many hours does it take to produce one unit? And we're going to go over here to letter D in finished goods. It takes 0.5 hours. So we're going to say 0.5 hours to produce that all the way across. And therefore, the number of hours to produce will be the units we want to produce times the numbers of hours that it will take. And these shouldn't be dollar signs. I'm going to change that to just a general formatting. So it's going to be general. It's 0.5 hours. All right. And then we're going to say, copy that across. And then we're going to give the rate per hour, which in this case is 15 in letter D again. So now it costs $15. So we're going to take the number of hours it takes times 15, and that will give us the amount that we will pay in terms of direct labor. So we can sum this up this way. This is the total hours, and then we're going to multiply those out all the way across, sum that this way, and there we have it. Once again, these 3/4 will be 450. Could also tie out between the total hours times the cost per hour. Then we're going to take a look at the factory overhead budget. So we have E says the overhead is allocated based on direct labor hours. So remember, that means that we're using direct labor hours to try to figure out how to allocate the overhead. And so overhead doesn't directly deal with direct labor hours. It deals with the labor hours in order to help us to allocate. We have a predetermined overhead rate of $270 per direct labor hour. Therefore, we're going to start off with, in the factory overhead, the labor hours needed. And we just calculated the labor hours needed. So we're going to say that equals, in this case, for April, the 9,850 labor hours needed for April. And then we're going to take those across. Once again, we're using the labor hours not because we're calculating the labor like we did here. We're calculating